Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
I can also examine daily changes in my own P&L. So these are the types of things that kill us, right? When we trade, day-to-day changes are a lot more important than end-of-period returns. So one of the things we've shown here is dollar changes in equity curves. So you see, you were like one day you were up 1,500, the other day you were down 7,300 on a $100,000 account. Is that big or small? I mean, that's really up to your level of comfort to see whether you can handle this kind of volatility. And similarly, we do that in percentage terms, right? So this was like 4.8% move. So let me move down here a little bit, and again, we're showing some not histograms, some scatter plots. But this actually displays a full history of trades that the system performed, and the interesting part is it's sort of behaving as expected. We have 18 delta iron condors are typically like 65% probability trades. The actual probability is very close here. It's about 67%. So most of these trades are worked out. There's a few bad losses in here, but overall, this premium selling has worked pretty well, and it even survived. Like if you look at this, the 2008, the market tanking in 2008, and then later on in March of 2009. We've been selling these things fairly consistently, and it's still generated positive return. When the actual underlying rate of return, was like, let's see, annualized basis was minus 23%. The strategy rate of return, so this program generated a positive 15%. It was uncorrelated with the market, right? So it's another way of saying it was kind of a delta neutral. And another relationship to note is that the SPY was inversely related to its implied volatility, which is what we'd expect. We'd expect as the market goes down, that the volatility increases and vice versa. Well, does that really work in the FX options world? So let's check that real quick. Okay, so here I have a little bit less of the data for the EUI. It's a newer index. I don't have that much historical data, but it's sort of enough to run some basic tests. And let's do the same thing. I'll do the Iron Condor 18 Delta. We'll sell it and hit run. So one of the things here, this was a similar risk profile, so clearly not, hasn't performed as well during this period of time, of course. One of the things that I want to point out, which will become important later on, is that again, this correlation structure. We'll see in this Iron Condor versus the underlying that there's really no relationship there, which is what we would expect, and is basically the same as for SPY. But there's also not a whole lot of relationship between the implied volatility and the price of the EUI. So we cannot expect the volatility to behave in a similar way to the VIX and SPX behavior that we see in equity indices. That's sort of one of the key findings is that, well, two key findings is that premium selling probably isn't going to work in the EOI product, and the volatility structure, the dynamics of volatility are different. So we really need to take that into account when managing trades. So let me now switch back. Okay. To the presentation. Okay. So we talked about what doesn't work, right? So the premium selling doesn't seem to be working. What does work, right? And I guess that's a better question. So what I want to show you, kind of two trades that I queued up, and I'll give you the rationale for both of them. I think that some of the things that we've seen would help you understand like why I'd prefer these types of trades in FX to the traditional kind of just premium selling in equity indices. So for that, I'm going to switch back to sharing my screen. Okay, and I will show you two trades. So the first trade I want to show you is the debit call spread that I'm doing on EUI. So one of the things that we talked about is the skew relationship in the calls for the EUI index. And if you look at the implied volatility, you basically, these numbers here, the implied volatility column, you'll see what we're seeing sort of graphically, that there is a steeper and increasing skew on the call side in EUI. So I'd rather be buying the closer to the money or in the money options and selling the out of the money options than the other way around. Also, the market is sort of weighing us that way and kind of implying maybe that there is a rally in the U.S. dollar. So if I buy into that premise, what I want to do is I would execute this debit call spread. And the one that I've set up here is a vertical spread where I am short the SEP 78, which is SEP 78 is the out of the money, and I am long the in the money SEP 77, right? And based on sort of current prices, I can do that for 50 cents, and doing it 20 times, that's basically a $1,000 trade, right? So I'm kind of risking 1,000 to make 1,000. So this is, theoretically, this is kind of a flip of the coin. But if we believe in this in this premise that the dollar will continue to be rising, this is a very nice way to express that view.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.